We are in the midst of a cultural war about the purpose of business. When we talk about a successful company, it shouldn't just include revenue growth, earnings per share. Those are important, but they're not the only metrics for a successful business. It absolutely should include employee engagement. It should include community involvement. It should include how you are managing your environmental footprint. Those should be natural metrics we use to define a good business. The purpose of business is about creating value for all of its stakeholders, not just exclusively its shareholder. And what I'm excited to tell people is over and over and over again, I'm seeing that they're not a different choice. In fact, trying to consider and make decisions for your stakeholders drives value for your shareholders over the long haul.
Welcome to the Work for Humans podcast. This is Dart Lindsley. Bart Houlahan founded his $250 million company And One on principles of not just profit, but also caring for employees and the environment. But when he went to sell the company, corporate law required him to sell it to the highest bidder, regardless of whether or not they shared those values. Within 6 months, the employees were all laid off, and the sustainable supply chain that he'd built over years completely shut down. I have enormous respect for what Bart did next. He set out to change the system that had made that unavoidable. In 2006, he co-founded B-Lab to both create a corporate framework to make it legal for corporations to serve a triple bottom line, and to set up a rigorous method to certify that they are living up to those principles. Currently, there are over 8,500 certified B corporations across 150 industries in over 80 countries. And now, Bart has taken his work a step further. As a partner in Irrational Capital, which offers an exchange-traded fund based on the strong evidence that the stock of companies that treat their employees well simply grows faster than the ones that don't. In this episode, Bart and I talk about the foundation and purpose behind Irrational Capital, corporate culture as a new investment factor, and why companies that treat people well outperform. We also talk about Bart's experience with And One's rise and fall, the 3 main components of a B corporation, the long-term benefits of stakeholder capitalism, and other topics. So, if you enjoy Bart's insights today, please don't forget to subscribe wherever you listen to podcasts. And now, please enjoy this engaging conversation with Bart Houlahan. Bart Houlahan, welcome to Work for Humans.
Thank you, Dart. It's really a pleasure to be here.
Here at the Work for Humans podcast, we've been exploring for a while now, almost 100 episodes, as a matter of fact, how we might design work better. And there's a piece of the puzzle that I think we have not covered deeply enough. And you're really going to help to fill in that piece of the puzzle, which is that we have not gone deeply into the cultural and, in particular, the legal context in which the decision to invest in the experience of employees is made. You're one of the co-founders of B-Labs. B-Labs is the certification organization for benefit corporations, public benefit corporations, which have employees as a key part of the stakeholder landscape. So thank you so much for being here, because it's really important for us to understand that story. And today, you're working with Irrational Capital. And I want to start there, in part because it's the most recent thing, and it's something that maybe people who know everything about B-Labs haven't heard about, but also because then I want to go into the backstory. So what is Irrational Capital?
First, congratulations, Dart, on almost 100 episodes. That's remarkable and really important work. Honored to be here. Irrational Capital is an investment research firm with an intriguing and relatively simple investment thesis. They believe that companies that treat their people well will outperform in the equity market. And this is really premised on the recognition that when you ask business leaders across the globe what their most important asset is, invariably they're going to say their people, right? But the truth is, from an accounting perspective, people or human capital shows up as an expense on your income statement And it's notoriously difficult to measure. And so our friends at Irrational Capital fundamentally think as a result, people are misunderstood and mispriced in the equity markets. And so they set about trying to prove a connection between corporate culture and equity performance. And this is all based on the social science of one of our co-founders, a guy named Dan Ariely. Dan's a world-renowned behavioral economist, and he fundamentally believes that when you talk about employee motivation, we measure the wrong things. We measure things like pay scale and benefits, the things that are easy to count, right? But what really drives motivation are the intrinsic motivators, things like pride and trust and transparency and psychological safety, purpose, fairness. All those intrinsic motivators drive productivity to a much greater degree. And so Dan and the team went about taking these intrinsic motivators and a different way of measuring employee engagement, and they applied it to a proprietary database going back darn near 15 years, incredibly deep, rich, and broad database. And indeed, what they found was a statistically verified link between corporate culture and equity value. And when then they back tested that data, it showed up that this wasn't just a connection, it was indeed a new investment factor like growth or value or momentum. But really importantly, it was uncorrelated with those other investment factors. And year in, year out, it was producing outperformance. And so what we do at Irrational Capital is we take this new factor that we've coined the human capital factor. We bring it to investors in the form of funds, in this case, ETFs that are traded on the New York Stock Exchange. We call them the Happy Suite. We have 3 of them. The ticker symbols are HAPI, HAPS, and HAPY. And then also, Dart, we bring to companies an opportunity for them to better understand the human capital factor through a rating where we can rate the company and benchmark them against 4,000 other companies in our database. We can do it by business division or seniority or gender and provide actionable insights for them to improve their human capital factor and therefore drive equity value. And so that's what we do at Irrational Capital.
I love the combination of the two, that it's not just, hey, everybody, here's something you can invest in that'll do great. It's also, how can you behave, companies? How can you structure yourself? But the funny thing is, I want to get really deep into all of the proprietary stuff behind it, which you're just going to have to stop me if I get too proprietary. But you could measure businesses based upon how they structure themselves, or you could measure businesses based upon how employees talk about them. So one of them is the structure, and the other one is the outcomes. Do you do both? Do you hanker on one?
Great question. And backing up for a second, you touched upon something that's incredibly important to me, and this will play into the rest of the conversation we're going to have. Dart, the reason why I joined Irrational Capital is that I think if we do this right, if we do both provide opportunities for investors to deploy capital based upon the human capital factor, and companies to actually understand their own rating and therefore improve it, it should act like a flywheel that ultimately changes corporate behavior. That is why I am there. And now coming to your question about what are we looking at? We're looking at the outcomes. We're looking at employee sentiment data fundamentally. And so we're evaluating tens of thousands of data points. In this case, our data set is, I think it's 750 million data points going back more than 15 years, 70,000 companies. And we're looking deeply at not only current employee sentiment, but also historically how it has moved.
Now, in other conversations of yours or things that you've written, I've heard you say that for B corporations, that the principles of being a public benefit corporation will have long-term return.
Yeah.
That it may not be the kind of return that you see in a quarter, for instance, or in a year. But as an investment, how long is long-term return?
Important question. What we're looking at, let's make this really specific. we're looking at data from 2023 that we then use to choose our portfolio for 2024 moving forward. And Dart, we only rebalance once a year. And the reason why we do that, to your point, is that corporate culture has like a 2.5 year half-life. And so we can take data from the prior year, make 1 year or an annual rebalancing based upon that data. And it's about the future equity performance that we're looking at. And so you're exactly right that ultimately, when somebody walks into an organization, we have a case study of a large technology firm that brought in a new CEO. And the new CEO decided that they were going to put people first and really drive corporate culture and rebuild an emotional connection from the employees to the organization. And what we saw was that it actually took over a year for our rating to start to improve. And then the stock price was a further year out. And so this is not a quarterly investment strategy. This is about moving capital into organizations that are fundamentally committed to their employees and as a result are generating stronger motivation, stronger financial performance, and better stock prices. Does that make sense?
Yeah, it does. I love that term, that culture has a 2.5 year half-life. I mean, the truth is, in every part of the world except stocks, 2.5 years is not a long time. I've never invested in anything in my life that I didn't expect to hold for 30 years. And that's true even now when I'm actually drawing money out because I'm semi-retired. And so the idea that for me, investing in a company, the idea that that's something that's a signal that's going to show up in the stock price 2.5 years, great. But I'm also really pleased to hear that it does show up as specifically as that. So you've certainly got the data that you've got, but do you see a cloud of research that's supporting the thesis that investing in employees is good for the growth of a company?
What's super interesting about the body of research that exists is I want to be clear, this is not a new idea, right? The idea that corporate culture could drive financial performance has existed for 30 plus years, Dart, as you know, right? Going back to Peter Drucker and corporate culture will eat strategy for breakfast, right? We've heard about this for decades. What is intriguing about the data that we have and the analysis we have is that we've taken it all the way through motivation, productivity, financial performance to equity value creation. That is what is unique about our data and our approach. But the idea that employee engagement, corporate culture can drive financial performance, reducing attrition, increasing retention, improving safety, improving productivity. There is an enormous, beautiful body of literature that backs that up. The evolution that we've brought is taking that all the way through to equity performance.
And I can tell you from interviewing a lot of people that there's a lot of academics in the world who have done those studies and look at them and are just bewildered why so few companies have picked up an investment in culture and in employees. It's just bewildering, actually, to them. And they write book after book saying, look at the evidence. And so I think we're going to get into why all that evidence hasn't had an impact in the past. I also think that what you're doing is a part of what could tie all of that evidence to action in companies. So it's super, super important. I want to go back into the story of your company, And One. And I want to talk about the path you went through And One that led to standing up B Labs. I am clearly not fashionable enough to know what And One was. I play basketball, but I'm not a fashion plate. So what was And One, and what were the principles that you set it up under?
For your listeners who don't know And One was a basketball footwear and apparel business that peaked in the late 90s, early 2000s as the second largest basketball company in the world. We had revenues of about $250 million. We were distributed in 80 countries. We had about 82 NBA players in our product. We had an entertainment division called the And One Mixtape that popularized street ball. It included a TV show, a video game, a series of DVDs. And what most people don't know about And One, it was actually started by my best friend from college and his best friend from growing up. I was, I think, the sixth employee at the firm and joined and eventually became the president. And as we were building this company, Dart, we wanted to build a company that we were proud of. And what that meant to us was putting our people first. We invested deeply in our employees and treated them like family. We built an ethical supply chain overseas that we were proud of. We were building incredible relationships with our retailers who were fundamentally partners in the business. And ultimately, over 11 years, what we learned was that wasn't just the right thing to do, but a better way to do business. We were bootstrapped, Dart. We had never brought in outside capital. And we were at the same time doubling every year. And not surprisingly, on 6 different occasions, we damn near ran out of capital because we were growing so rapidly. And on each occasion, it was those relationships, the relationships with our employees, our suppliers, our retailers that bailed us out. Now, fast forward to the time it came to sell the business in 2005. We'd had a good run. It was time for us to move on. We had done a leverage recapitalization that had brought in a private equity player. And it was the right time for this leadership team to sell the company. And the fundamental reality is that the buyer did not share those values. And within, 3 months, had terminated all 300 of our employees. He got rid of our ethical supply chain. He got rid of all of our environmental efforts. He got rid of our charitable giving, our direct service programs. And the company went from 250 million in revenues to 40 million in 3 years' time. It just collapsed. And looking back on that, Dart, I just felt like there had to be a better way, a way that a company could scale and raise capital and even have a liquidity event and still hold on to its mission. And so that was, for me, the seed for B-Lab. And we can talk more about B-Lab, but that's how I ended up there.
So I want to go back through some of the decisions you made in A1. First of all, I want to talk about the decision to sell A1 to who you sold it to. And the answer is, you really didn't have much choice. When you were responsible to shareholders, you need to sell to the highest bidder. Was that the case at the time?
Absolutely. And so, yes, And One, over the course of our 11 years, we had brought in outside investors. And so we had about 150 investors in the organization. And when it came time to sell the business, I remember the conversations we were having in the boardroom, right? We had built a company that had purpose at its center. But the truth is, at the moment of liquidity, the moment of a sale of a company, your fiduciary duty is relatively clear. You're required to maximize the return to the shareholder. And what that means is the only thing that you can really evaluate if you have outside investors is the highest cash offer on the table. And that certainly was true at And One. We wanted to try to maintain our commitment to our employees and our community and the environment, but at the moment of sale, it's not relevant by law.
When you were setting up And One, you decided that it was not going to be purely about financial maximization. We had Yancey Strickler on the show, and he was talking about how the ethos of financial maximization has a lot of downstream effects that are bad for our culture. Why did you decide to do something different from financial maximization? You were coming out of the finance industry, if I remember correctly.
That's correct.
A finance industry that was very focused on financial maximization. What was it that led you to think differently?
It comes back to values, Dart. We had a group of friends that were given a white sheet of paper, and we weren't coming from the basketball, footwear, and apparel industry. We came from a variety of backgrounds, and ultimately, we all collectively decided it was critical that we build something that fundamentally we could look back on with pride. I'll be honest, when we made those decisions, I don't think we were thinking about trade-offs. we were making decisions that were about the values we held and what we wanted to bring to our work. Now, you're right, Dart. I started my career as an investment banker, and I spent about 6 years in that industry. And if I'm really honest with myself, every day I went to work and I hung up my coat and I also hung up my values before I sat down in my cube, worked 90, 100 hours a week, at the end of which, I'd write a nice charitable giving check at the end of the year to try to make sure I was doing my part. And it felt like my life was misaligned, that I was living one set of values outside of work and one set of values inside the office. And I really didn't want to do that anymore when I was able to make the decisions with my partners about what the values of this business would be. I don't want to pretend that we were looking at decisions we were making about committing to our employees like family as, well, we're making a hard trade-off here. It was more purpose-driven. What do we want this company to be? And to our delight, Dart, we found over the years, as I mentioned, that indeed it's a little bit of a false dichotomy to say that these decisions will ultimately cost a company a material impact on their finances. We saw that this commitment to our employees and the community and the environment over the long haul, to your prior point, over the long haul, built a more resilient business, built a company that was profoundly profitable and grew to be the second largest company in basketball in the world.
I will tell you the conversation that goes on a lot in my circles. My circles are people who want to see companies become an engine for work that makes people feel whole and alive. That's my mission. And you're never going to be able to sell that into a company because business leaders only listen to financial maximization. That's the only pitch that they're going to hear. Do you feel that that's a caricature? That there are a lot of business leaders who hope for more, but that they are often trapped in a corporate structure that won't let them? Do you find that there is a large appetite for that if we can break out of the corporate structure that has fiduciary responsibility solely to shareholders?
Certainly, it's a caricature. I think there's different elements of this question. The first element is about business leaders, entrepreneurs, and corporate leaders. I would be stunned, Dart, if you had a one-on-one with an entrepreneur or business leader where they said, the core focus of my organization is to maximize my return to shareholders. What I have heard from business leaders, both traditional and certified B corporations across the globe now for 20 years, is of course they manage their organization for all of their stakeholders. Of course they consider their decisions and the impact they have on their employees, on their supply chain, on their communities, and now to an increasing degree on the environment. That's just good business. That's not being a company that is a nonprofit at heart. So business leaders consistently are focused on stakeholder management and making sure that they are providing value for all of their stakeholders, consumers, workers, community, environment. And you hear that over and over and again. That is different than what their legal obligation is. Their legal obligation is to maximize the return to shareholders. And they have pretty material pressure on them from the capital markets, which are looking for not long-term return, but are measuring organizations on a quarterly basis. And it is one of the reasons why we started B-Lab, right? One of the reasons was to try to bring into alignment these separate pressures because we have data that shows that our community of certified B corporations are simply more resilient than traditional businesses. We have evaluated attrition rates during two of the most profound financial crises of our lifetime, 2008 and the global pandemic. Let's use the pandemic as an example. In a moment, Dart, where as high as 1 in 3 small, medium-sized businesses were failing across the globe, our community of certified B corporations had an attrition rate of less than 5%. And they'd tell you that they survived not in spite of their commitment to their employees, community and environment. But because of it, it made them a more resilient business, one that could survive the variability and volatility in markets. And so it's important that we separate these things out. What your fiduciary duty is, what the pressure is from the financial markets, and what business leaders fundamentally believe. Do you remember back in 2019, when an organization called the Business Roundtable, it is, I think, 181 CEOs of the largest American companies. They came out with a statement about the purpose of business. And they fundamentally said that they were no longer going to lead their organizations exclusively for maximizing shareholder value, but instead to create value for all stakeholders. Now, the truth is that was culturally a really important moment for the broader movement of trying to move us from a shareholder economy to a stakeholder economy. But I would tell you, to their core, those business leaders believed that long before they wrote that statement and had the courage to put it out.
Yeah, that makes a lot of sense to me. And it's what I believe too. But also those business leaders were, many of them, trapped in a fiduciary responsibility that may have made that difficult.
Totally agree. And that's at the very center of the work at B-Lab, is how do we align an economy that we want to move more towards creating value for all stakeholders with a governance structure that would support it.
I'm going to ask you sort of an obvious question. I don't know if you know the movie The Princess Bride, where the evil scientist
Love The Princess Bride. Love The Princess Bride.
tortures the hero using this horrible contraption, then says, "How does that feel?" And so I'm going to ask you one of those questions, which is, how did it feel to see your company changed after sale, transformed after sale?
Yeah. First, I want to be clear that the gentleman who bought the company paid fair price. It was his business, and he could do what he wanted with it afterwards. Simultaneously, to have the purpose ripped out of the business within 3 to 6 months, to see all of the employees that we had invested in for 11 years terminated, to see a supply chain that we had worked to make second to none in terms of its ethical approach terminated. They eliminated the entire supply chain and went vertical in their supply. I remember a conversation at a sales meeting where one of the sales team asked the new leadership team, A&One's always been committed to charitable giving. It's given 5% of its profits year in, year out to educational nonprofits. Do you intend to maintain that? And the response was, there's a new charity in town. That's this management team. That was
Wow.
brutal, Dart. That was brutal. It was really hard to see something that you had invested 11 years of your life and you were deeply proud of have the values of the company ripped out of the organization in such a short period of time.
It also says something about the half-life in the other direction of culture, which is that you can improve it if you're serious fairly quickly, and you can demolish it quite quickly. And so when you set up B-Lab, well, it's a complicated question because on the one hand, what I want to ask is, did you expect it to be hard, and was it harder than you expected? But when you set up B-Lab, it may not have been what it ultimately became, which was much more transformative. So when you were setting it up, did you think that you were going down a path that might be big?
When we started B-Lab, the focus of the organization was relatively narrow. We were trying to create an alternative, a way for a company who opted in could be recognized for and maintain its values for the long term. So it could go out and find new management and even new owners and know for the long haul that the values and purpose of the business would be maintained. And the truth is, Dart, we were wildly ignorant. There were hundreds of thousands of companies that were already operating as, at the time, the term was a triple bottom line business, one that was focused on profit, people, and planet at the same time. And as we spent a year just listening to the market, we realized that perhaps we could have a broader impact, that instead of creating an alternative, that maybe, just maybe, we can move the entire economic system towards a more sustainable future. And so relatively rapidly, what started as a relatively narrow focus, the aperture of that lens grew. And we became essentially an economic systems change nonprofit, focused on building a more inclusive, more equitable, more regenerative economic system.
I always ask this of leaders who pursue paradigm change, which is that you're supposed to face resistance, and actually sometimes violent resistance when you are going after a paradigm change. Did you run into forces that were really opposed to what you were doing?
Absolutely. And the truth is, those forces persist. There are whole institutions that have been built with compensation structures that are fundamentally structured around maximization of profit for shareholders. In the idea that we would be shifting the economic system from one that exclusively focused on shareholders, something that's called shareholder primacy, to one that required businesses to balance the interests of all stakeholders, is unequivocally running into, it has had real resistance over the last 19 years from entrenched powers. And so, of course, in that, this is a generational plague, Dart. We're not going to move the economic system towards more sustainable future in a generation. It's going to take real time for us to make that type of progress. Our job at B-Lab was to build the infrastructure for that type of shift to happen over time. And so we talk about that infrastructure really as three different pieces. The first piece is a community of leaders who embody that change that we're trying to drive collectively. The second is a set of standards that redefine success in business, Dart, so that we no longer measure the success of a business exclusively based upon their financials. And then third and finally, it is about creating new rules of the game so that if we really want different outcomes from a business, we're going to have to give them a different set of rules. And the current rule is maximize the return to one stakeholder, the shareholder, and we're trying to move them to a place where they create value for all stakeholders. And so that's the infrastructure we're trying to build, a set of leaders that makes it tangible, coupled with standards and structural changes in the law that provide the underpinning for that shift. Does that make sense to you?
It does. I want to talk specifically about the standards as it relates to the workforce. What is the character of those standards?
First, zooming out, and then we'll zoom back in. Okay, so let's zoom all the way out and make sure that people understand what the standards are used for and why we develop them. And then we'll go deeply into the worker standards because it's a critical component of the standard. And so if we zoom out for a second, ultimately, those leaders that I just was talking about, those are our certified B corporations. For your listeners who don't know what a certified B corporation is, it is a certification for a whole business. We thought the evolution of the market around certifications was going to be from you and I, Dart, not just buying an organic apple or going to a LEED certified building, both really important, but instead deciding to patronize a good business, going from a product or a practice to the whole company. And to be certified, you got to do three things. You got to take and pass a set of standards that we were just talking about. It's called the B Impact Assessment. And importantly, those standards look at everything you do. They look at your impact on your consumers, your workers, the community, the environment, and your governance practices. The second requirement is you got to make sure your company's built to last. And that requires a legal change. You either rewrite your current legal documents or you reincorporate as a benefit corporation, that new legal form we created that allows you to consider all your stakeholders. And the third requirement is you got to be transparent. You got to share not only your areas of excellence, but your areas for improvement. If you do those three things, you can certify as a B corporation. There are now almost 8,500 certified B corporations in 93 countries, 150 different industries. Their commonality is they're all leading a broader movement of people using business as a force for good. Now, coming back to the specific question you had around the standards, one deep dive in the standards is around workers. And in that set of standards, we're looking at everything that impacts the lives of workers, ranging from corporate culture all the way across to equitable pay. We look at deep questions around DEI. We're looking at the benefits that are provided by the organization, the work-life flexibility that's embedded in the organization. We look at accessibility. We look at employee ownership, whether there's ways that employers are lifting workers up through their ownership structure. All of that is included in this set of standards.
I like the idea of transparency. It's one of my favorite things, the most attractive things about what you were just talking about. And the reason is, I've wondered this question, which is, in other discussions, you've talked about the risk of greenwashing, which is sort of the risk of B washing, which is looking like a B corporation, but not being one. And I have a related question to that, which is that I've gone through the motions of doing ISO certifications for companies. And whenever I'm doing it, I'm like, well, what's the spirit of the ISO certification? Let's really try to live up to the spirit of it as well as the letter. But I think it is very possible to really just pursue the letter of a certification without knowing why, without feeling in your heart why. And I'm wondering if this kind of certification can be successful at the level of the letter, or it needs to start from the spirit of the law.
We have, as I mentioned, 8,500 certified B corporations and about 4,000 companies in queue who have applied to certify. And if I'm honest, Dart, I don't know what's in the heart of every one of those leaders. It's just too many companies, right? And so the question is, how do you build a system that tries to ensure the credibility and the integrity of the mark of the certification itself? And to your question, I think there's 3 critical pieces that we pursue at B Lab to try to make sure that this is a credible certification. The first is when you look at standards and frankly, driving impact, there is a theory in social science that you go from policies to practices to inputs, outputs, to outcomes, to impact. Okay? And the intention with the standard is to walk people through that line so that they are taking the appropriate steps to try to drive the outcome and impact that they desire. And so we're going to give you the roadmap. We're going to tell you what policies to put in place, what practices that are necessary, what you should expect as inputs and outputs, what outcomes it should drive. We're going to ask you about all of it. But really importantly, Dart, all of that is not equally weighted. And so to your question, if you're putting policies and practices in place that are not producing the necessary outcomes for change, you're not going to reach the bar for certification. The certification requires a score of at least 80 on this impact assessment. Now, believe it or not, that is 80 out of 200 points. And I often get the question, really? 40% is a passing grade? The standard is intentionally aspirational. It's trying to give you the roadmap to improve and manage your performance. And as a result, the average score for anybody who takes that assessment, Dart, is about a 50. The average score for the community of certified B corporations, these leaders, is about a 95, less than 50%. And so the whole point is to try to change the behavior of business. And ultimately, that's about giving them the roadmap for continuous improvement. And so to your question, the first thing is we weight outputs and outcomes far more than we weight policies and practices. Therefore, you're not going to be a B corporation if you're stopping at practices. Secondly, equally importantly, we're going to hold you accountable. We require you to rewrite your corporate governing documents where you say that you are going to balance the interest of all stakeholders. And so this isn't just based upon whether you're going to be able to maintain a certification. You've created a new covenant with your shareholders where you've given them incremental rights. They can now expect you to, they've given you the permission to manage your business in a different way, to manage all of your stakeholders, and they're going to hold you accountable. They have incremental rights to hold you accountable to managing your business in that way. And so the second critical component is you are legally accountable to actually drive those outputs and outcomes. And so third and finally, we've talked a little bit about it, you're transparent as well, right? You got to share your areas of excellence with your areas for improvement, and we verify it. And the combination of the transparency and the verification also leads to, frankly, trust in the credibility of the certification.
It's funny, I realize I don't really understand what the word fiduciary means, but I think it means money, and I think we need a new word.
We do.
Because now we have a responsibility that's not just fiduciary, it's bigger.
It is broader than that. That is exactly right.
Yeah.
Fundamentally, we talk about how we've expanded fiduciary duty to include consideration, the interest of all stakeholders, and the balancing of those stakeholders.
So I have I think a fairly fast question before I have this other question. What's the limit? How big a company has ever made this transition? So my question is, could Apple tomorrow decide we're going to be a B Corp? I mean, it seems to me that there comes a point where you are so invested in a traditional shareholder structure that it becomes increasingly difficult to become a B Corp. So clearly, it's better to be born a B Corp, but is there a limit in size where it just doesn't become feasible anymore?
I'm going to parse your question because Apple could absolutely decide tomorrow that they want to be a B Corp. I am relatively certain they could not become a B corporation tomorrow. Okay, and so let me make it really tangible for you, Dart. If I go back to 2015, we at the time had certified a subsidiary of Danone, the dairy giant out of Paris, a company called Happy Family that was an organic baby yogurt company. So they made organic baby yogurt, or organic yogurt for babies is the better way to put it, right? And they had certified early on, and it was a subsidiary of Danone. And their certification had inspired interest across Danone. We call here in the US, we call Danone Dannon. So this is Dannon yogurt, right? Just to provide clarity for everybody.
Yeah, I thought I was just saying it wrong all this time. So,
and so Happy Family was acting as an entrepreneur inside Danone, getting people excited about this new concept of becoming a certified B corporation. And in 2015, their CEO at the time, a gentleman named Emmanuel Faber, declared that he was going to certify the parent organization, the $40 billion dairy business out of Paris, Danone. And his pathway to do so, Dart, was going to be a 10-year pathway. Danone at the time had 164 subsidiaries, and they were going to certify subsidiary by subsidiary by subsidiary. At this juncture, we're a little over a year and a half away from the target end date. I think they're over 80% now in corporate revenues that they have certified as they've gone region by subsidiary through their entire portfolio. And that's a massive undertaking and a massive effort. And so the answer to your question is yes, any company can become a certified B corporation. The changes required to actually get there might be monumental, but the intention is to try to create a community of leaders that inspire companies to be more like a B corporation, right? If we go back to the beginning of this conversation, we were talking about economic systems change. And if I'm really honest with you, Dart, there are enough certifications in the world. There are enough bugs around the side of a coffee bag today already. And so what's the purpose of our certification? It is a means to an end. It's identifying a leadership community that will inspire others to be more like a B corporation. And our job at B Lab is to give them the tools to actually start that journey. That includes the impact assessment we discussed so that they can measure, manage, and improve their performance. And it also includes the legal framework so that if they want to adopt a stakeholder governance model, it was available to them. And so though we have 8,500 certified B corporations, we work with more than 300,000 companies that are using our tools to be more like a B corporation. And that is at the very center of this movement, the idea of economic systems change and inspiring more companies to join the broader movement.
So recently, After the OpenAI drama, I heard some commentators say, look, this is a perfect example that a company that's supposed to represent everybody often represents nobody other than themselves and their own specific objectives. And I'll tell you what I heard in that, because first of all, who was talking about that? It was somebody from the financial industry who was saying that. But they cite a 2003 paper by Gompers and Ishii and Metric. And that paper found a correlation between strong shareholder rights and higher profits. But there was a paper that came out in 2006 that said that the original paper was flawed, that it hadn't recognized that different industries have different governance and that different industries were behaving differently in their profitability through that time. And so essentially what it was picking a paper, an academic study, that flattered previous assumptions. I'm not pointing fingers at all. I do that all the time, right? And so I'm deciding I'm going to anchor on the later paper because it flatters my biases. But on some level, is there a religious war underway? And when I think of religious wars, I think of the disputes between Keynes and Hayek or Friedman. I have always felt that the reasoning on both sides was highly motivated by something other than evidence. And so my question is, when you dig under that, is there a mental model that you recognize that is the foundation of the difference?
Yeah. So a couple of things to first make sure you and I are talking about the same thing, Dart. Importantly, adopting our legal framework, either becoming a benefit corporation and or making changes to your membership agreement as an LLC to include the interest of stakeholders, has nothing in the world to do with weakening your governance. We're not advocating for weak corporate governance. We're advocating for governance that is governing for a different set of outcomes. That's very different than saying we're trying to weaken governance. In fact, our focus is on trying to build extraordinarily strong governance with clear accountability, trying to drive a different set of outcomes. Those outcomes being creating value not just for the shareholder, a really critical stakeholder, but instead creating value for all of the stakeholders, making sure that you're delivering value for your employees and the community and the environment along the way. And so the job at B-Lab has always been provide clarity about what we're trying to do. We're not trying to undermine corporate governance. In fact, we're strong believers of strong corporate governance. We're trying to change the fundamental set of duties they're trying to operate against. To that end, the second requirement of the movement is making sure we're also clear that this is not necessarily concessionary. Coming back to our prior conversation, Dart, I think the opening gambit from folks who are traditionalists and believe that this is going to reduce the profitability of the business is that by nature, these are concessionary decisions. And what I mean by concessionary is that you're going to give up on either share price or a profitability that what you're investing in your employees, the community, in the environment. And in my entire career has been proving the opposite. I saw it firsthand at AN1 that investing in our employees and putting our people first, whether it be the supply chain or our partners or our employees, resulted in a stronger business that was able to scale. I spent 17 years at B-Lab trying to make sure that there was clarity that, of course, the community is made up, Dart, of a beautiful spectrum of companies who might choose, frankly, to take a lower return and maximize impact. But that's a choice. There are organizations like Patagonia or Dan & Yogurt or Warby Parker or Allbirds. There are public companies, dozens of them, that are part of the community of certified B corporations that fundamentally believe that over the long haul, an investment in their stakeholders is going to lead to a more resilient business and therefore generate better long-term returns for their shareholders. And that they aren't necessarily, by definition, concessionary.
Yeah. The way I've heard the concessionary concept phrased is if you focus on multiple stakeholders, it's going to come at the cost of other stakeholders. And the truth is, in a complex system, if you optimize for one outcome, it may come at the cost of that one outcome, which is that a complex system depends upon multiple stakeholders.
That's exactly right. That's exactly right. And again, reemphasizing where we started, business leaders would agree with you wholeheartedly, Dart, that at the end of the day, they're running their business for all of their stakeholders, trying to drive a resilient, profitable business over the long haul.
And so you came through this through B Lab, and now you're working with Irrational Capital. It seems like that really completes a loop, which is that Irrational Capital and funds like it need to exist to create a stable of future shareholders who understand the value that B corporations are bringing to the table.
100%. Why I'm so excited about Irrational Capital is that it is bringing to the mainstream this idea that organizations that are people first aren't just the right thing to do. They are better businesses over the long haul, and they are providing capital, the lifeblood of all business, for those businesses that are excelling in their human capital factor or their people first philosophy. And so we absolutely have to continue to build a vibrant capital market that recognizes the importance of businesses that are lifting up, workers lifting up, the environment lifting up, the community, so that those businesses can thrive and scale. And coming back to my last statement, what has been fun about my short time at Irrational Capital is it is the culmination of 30 years focused on a people first philosophy, right? The first 11 was as a practitioner building a business that lifted up people first. The next 17 was as a nonprofit leader that was trying to demonstrate at scale that people first would actually be a way to build a better business, a more resilient business. And now I'm in a investment vehicle that has verified statistical evidence that indeed putting your people first results in a better equity valuation creation opportunity. And so it is a beautiful full circle bringing me back to the investment world.
I think it's incredibly important that stakeholder capitalism is not groovy. It's not hippies. It's not just people who are making granola. It is a robust, rigorous method for large companies and small to grow and thrive. You've used the word resilient, in a way that is resilient. Another way to say that is in a way that is going to preserve the legacy of the founders.
Yes.
And so if you as a founder or as a business leader are building something that is about more than financial maximization, and that's the legacy that you want to leave, then this is a way to make that possible. And I just think it's funny how, I can't remember where I heard this quote. It was basically a quote that said, when I cared about money, everybody respected me. When I cared about the people, they called me a communist or something like that. I can't remember what it was. But there's this feeling that here's an underlying belief. We didn't quite get down to the mental model, but one of the underlying beliefs, I think, is that money, because it's a number, is inherently more rigorous than other forms of measurement.
Yeah.
And so there's a way in which if I'm going to care about something that doesn't have the unit of dollar sign next to it, I'm soft.
That's right.
And I'm not rigorous.
You're exactly right, Dart. And it is part of the three elements of change that we're all going to need to see to try to get to a more equitable and inclusive and regenerative economic system. First, there needs to be change in corporate behavior. We need behavior change. At the core of the work at B Lab is about the standards that's trying to drive that behavior change. The second is structural change. We're going to fundamentally need to change the structure of corporate law so that we drive different outcomes from businesses. Else we're never going to get there, moving towards that stakeholder economy. But third and finally, Dart, what you're touching on is cultural change. I don't know, probably 53 years ago now. I don't remember the exact date. Milton Friedman wrote an essay that set us on a course that really defined the purpose of the corporation. Before then, if you go back to the beginning of how you received a charter from government to be a corporation, you had to demonstrate that you were creating value for your community and society. That is how you got a corporate charter. And for a 50 plus year cultural understanding, we have shifted to believe that the fundamental purpose of business is maximizing the return to the shareholder, maximizing profitability. To change that cultural narrative, Dart, that's what you're talking about. It's fundamentally redefining the metrics we use for success in business. Like when we talk about a successful company, it shouldn't just include revenue growth and earnings per share and debt to equity ratios. Those are important, but they're not the only metrics for a successful business. It absolutely should include employee engagement. It should include community involvement. It should include how you are managing your environmental footprint. Those should be natural metrics we use to define a good business. You asked about a holy war, I think was the word you used. I would call it a cultural war. We are in the midst of a cultural war about the purpose of business. And the purpose of business, when it began and where it should go, is about creating value for all of its stakeholders, not just exclusively its shareholder. And what I'm excited to tell people is over and over and over again, I'm seeing that they're not a different choice. In fact, trying to consider and make decisions for your stakeholders drives value for your shareholders over the long haul, whether that's at Irrational Capital or at B-Lab or at And1. That is my personal experience of 30 years in the business world.
I love that. And it's so funny that as you're saying that, I was saying, right, it's an and, not an or. And then I realized that your first company was called And1.
Yes, indeed.
So in closing, I often ask these questions. The background of this show is that a lot of what we're doing is we're looking at work as a product that companies sell. And so we are exploring the idea that all companies are multi-sided with customers. Stakeholders is one way to say it, but we'd actually say customers on both sides. And that employees as customers are subscribers to work. And so I ask marketing questions about work of everybody who comes on the show. And one of them is, what job do you hire your job to do for you?
It's such a great question, Dart. And you should, if you don't, you should have on one place on your site the responses to that question from your last 100 shows. I want to commend you. It's a brilliant question. And I think there are two things that I hired my job to do for me. And the first is that I have been incredibly fortunate to work with people I love, going all the way back to And1 that was started by my college roommate and the team that was built there. I, in And1, worked with my spouse. She was our chief operating officer. Moving on to B-Lab, the same gentleman who invited me into And1 was my co-founder at B-Lab, and we grabbed one of our great friends from college as well to be the third co-founder. And so ultimately, Dart, if I'm clear-eyed, my career has been as much about the who as the what, that I try to find organizations with individuals whom I care about, who I respect, and who I can work with every day, because you spend a lot of time at work, right? And you damn well better enjoy the time you spend. And that begins with the people you do it with. And so one of the jobs that I hired my job to do was to introduce me to and create great relationships, great friendships that I treasure and value inside and outside the workplace and hope to preserve into perpetuity. And the second thing I hired my job to do for me was to allow me to live a life that's values aligned. And what I mean by that is the dissonance I felt back on Wall Street when I walked into the office and felt like I was spending 80 plus hours a week doing something that didn't seem totally aligned with my own personal values was a place I never want to be again. I want to bring my whole self to work. I want to walk in the door and know that who I am outside the workplace is the same person I am inside the workplace, and my values are aligned. And so that's the second thing that I'm trying to hire my job to do.
Those are crystal clear and quite beautiful. What does your job cost you?
Opportunity. At the end of the day, the choice of a job is about opportunity cost for me. In our family, we talk about highest best use. What is your highest best use? A choice of profession for me has always been hopefully a choice of vocation. And what that means is it should be someplace that provides a real purpose and satisfaction, and indeed is delivering my highest best use. And if I choose wrong, it's a material opportunity cost.
That's a great phrase, highest best use. I am going to definitely reuse that.
Importantly, it's not mine, Dart. I can't remember who said it first, but it's not from me.
Where can people learn more about you, your work, all your work?
First, I'd encourage people to go to bcorporation.net if they want to learn more about the B Corporation movement and investigate whether they can use our tools to begin this journey to authentically engage with their stakeholders. And everybody's on a journey, Dart. Nobody is perfect, and this is about continuous improvement. So I'd start by encouraging folks to check out bcorporation.net. Secondly, Irrational Capital. It's irrational.capital. That'll bring you to our website. It'll tell you more about our ETFs. And if you wanted to, you could put capital into our ETFs that are traded on the New York Stock Exchange if you're trying to align your own values with your investment vehicles. So that's the second thing I'd encourage people to do. With regards to how to learn more about me, there's a variety of interviews I've done over the years that if you Google me, you can check me out. But honestly, one of the debates we had at B-Lab over the course of 17 years was how to make the work always about the entrepreneur and not about the nonprofit. If you're trying to lift up a new way of doing business, it's got to be centered on the leaders. And so I'd be honored if people wanted to learn more about me. I'd tell them first to go to bcorporation.net and learn about the real leaders and irrational.capital and about the opportunities to invest in those good businesses.
Fantastic. Thank you for coming on the show. I learned so much. I really appreciate your time today.
It was my pleasure, Dart. I look forward to continuing the conversation.
Thanks for joining me for another episode of Work for Humans. If you enjoyed this episode, please give us a 5-star rating wherever you listen to podcasts. And share the show with one person you think would get value from it. Believe it or not, this really helps us grow the show and reach more people who want to build the kind of work that people really want. As always, thank you to my producer, Jason Ames at Ninth Path Audio for his insights into content and his high standard for quality. Final note, the opinions shared here are my own and not the views of Google or Cisco Systems. Thanks again for listening. See you next time.